Imagine you wake up one morning and the news is different. Not the usual noise, something heavier. Borders are closing, supply chains are snapping, prices on things you buy every week have jumped 20% in a month. Your savings account still shows the same number it showed yesterday, but the number feels different now. Something has shifted. You can feel it before you can name it. And somewhere in the back of your mind, one question starts forming. What actually holds when everything else starts moving? That question is not new. It has been asked by ordinary people in extraordinary moments for as long as there have been wars and currencies, and men like Warren Buffett watching both very carefully. Most people think of Buffett as the patient, folksy grandfather of long-term investing. Buy great companies, hold forever, ignore the noise, and in peacetime, that framing mostly holds. But war is not peacetime. War is the stress test that reveals what was real all along. And what Buffett actually did during periods of geopolitical rupture tells a story that is far more interesting than the one usually told about him. Start with Korea. The early 1950s. America is at war again, barely 5 years after the last one ended. Inflation is climbing. The government is spending hard. Factories are being redirected. And a 20-year-old Warren Buffett, already studying under Benjamin Graham in New York, is watching something that most people around him are not watching. He is not watching the war. He is watching what the war is doing to prices, and what prices are doing to companies, and what companies are doing to their own earnings power. Graham had taught him to look for businesses trading below their intrinsic value. But what Buffett was beginning to notice was something Graham had not fully emphasized. Some businesses did not just survive inflation, they transmitted it. A company that could raise its prices without losing its customers was not just a good business. In a war economy, it was a fortress. The customer had no choice but to keep buying. The company had every ability to keep charging more. The gap between cost and price stayed intact, or even widened, while the currency around it quietly lost ground. This is where the first layer of the pattern appears. Buffett was not buying war stocks in the obvious sense. He was not chasing defense contractors or weapons suppliers. He was looking for something quieter and more durable, businesses with pricing power. The kind of power that does not depend on government contracts or military demand, but on the simple fact that people will keep buying regardless of what is happening in the world. But here is where it gets more interesting, because pricing power alone was not the full answer, and the next decade would prove that. By the time Vietnam escalated in the mid-1960s, Buffett was running his own partnership and doing extraordinarily well. But the war economy of the late 1960s introduced something different. Lyndon Johnson was trying to fund both the war and the Great Society without raising taxes enough to cover either. The result was a slow, grinding inflation that started eating into corporate earnings in ways that were not immediately visible on the balance sheet. Companies looked profitable, but the profits were being measured in dollars that were worth less each year. The real return was shrinking even as the nominal numbers looked fine. This is the trap that caught a lot of intelligent investors in that era. They were reading earnings reports that looked healthy. They were seeing growth. But the growth was partly an illusion built from a depreciating measuring stick. The dollar was getting smaller. The profits it measured were not actually as large as they appeared. Buffett saw this, and it changed something in how he thought about businesses during inflationary war periods. It was not enough to have pricing power. You also needed a business that did not require constant heavy reinvestment just to maintain its position. Because in an inflationary environment, reinvestment gets more expensive every year. A factory that cost $10 million to build in 1965 might cost $20 million to replace in 1975. If a business had to keep replacing its assets just to stay competitive, inflation was quietly eating it alive, even if the income statement looked fine. The businesses that truly survived these periods were the ones that could earn high returns on capital without needing to constantly pour that capital back in. consumer brands, dominant newspapers, insurance companies with float. These were not glamorous war plays, but they were the businesses that came out the other side with their purchasing power intact. Now hold on, because this is where the story takes a turn that most people miss entirely. By the early 1970s, Buffett had done something almost no one expected. He closed his partnership. He said publicly that he could not find enough bargains. He stepped back. And while other investors were rushing into a market inflated partly by war spending and easy money, Buffett was sitting still. This was not passivity. It was a form of discipline that most people in that environment simply could not maintain. The noise was too loud. The apparent opportunities were too tempting. Then came 1973 and 1974. The oil embargo, the Arab-Israeli war, stagflation. The stock market collapsed. Companies that had looked invincible a few years earlier were suddenly trading at fractions of their former value. And Buffett, who had been sitting quietly with capital preserved, began buying. Not cautiously, aggressively. He called it like being in a candy store. Washington Post, Geco, positions that would define Berkshire Hathaway for decades. What he had done was not predict the war or the oil shock. He had simply refused to overpay during a period when the market was pricing in optimism that geopolitical reality did not support. And then, when geopolitical reality hit hard and prices collapsed, he had dry powder while everyone else had losses. This is the second layer of the pattern. War does not just change which assets are valuable. It changes the price at which assets trade. And the investor who enters a war period with cash and discipline often exits it with positions that would have been impossible to acquire at any other moment. But there is a third layer, and it is the one that most people never reach: the Gulf War in 1991. Short, sharp, decisive. Markets panicked before it started and then recovered faster than almost anyone predicted. Buffett barely moved. He had already made his major commitments in the 1980s. He was not reactive. He was not trading the news cycle. He was holding businesses that he had already determined could withstand almost any external environment because their competitive position was structural, not cyclical. Then, September 11th, a different kind of war, sudden, traumatic. The stock market closed for 4 days, the longest shutdown since 1933. When it reopened, it fell hard. Buffett's response was almost eerie in its calm. He did not sell. He did not reposition. He had already said publicly before the attacks that he considered Berkshire to be essentially a financial fortress. And he meant it literally. Berkshire held billions in cash equivalents and owned insurance operations that were actually going to face enormous claims from the attacks. Yet he held. Because the businesses underneath the insurance operations, the ones generating the float and the earnings, were not impaired by the attacks. The world had changed emotionally. The underlying economics had not changed structurally. This is where the pattern becomes something more than just investment strategy. It becomes a philosophy about what is real and what is temporary. War creates an enormous amount of noise. Prices move violently. Sentiment swings. People make decisions based on fear that they will later recognize as panic. Buffett's edge was not superior information. It was the ability to separate the noise from the signal. To ask, not what is happening right now, but what will still be true in 10 years. And then, 2003, the Iraq War. Buffett had already been warning about the dollar. He had taken a large position in foreign currencies, something almost no one associated with him. He was not doing it because of the war directly. He was doing it because the combination of war spending, tax cuts, and a widening trade deficit was creating conditions that historically led to currency weakness. He saw the mechanism. He followed it. The dollar fell significantly over the following years. The currency position made money. But more importantly, it revealed something about how Buffett thinks during war periods. He is not just asking which stocks to buy. He is asking what the war is doing to the entire financial environment, to deficits, to monetary policy, to the purchasing power of the currency itself. That is a different question than most investors ask, and it leads to different answers. There is a final piece to this, and it connects back to that moment you felt at the very beginning, the one where the number in your account still looked the same, but something had clearly changed. What Buffett understood across Korea and Vietnam and the Gulf and September 11th and Iraq was that war does not destroy wealth uniformly. It redistributes it. It takes it from people who are holding the wrong things and moves it toward people who are holding the right things. The wrong things are usually whatever looks most liquid and safe on the surface, but carries hidden exposure to inflation, currency debasement, or broken supply chains. The right things are usually whatever has genuine pricing power, durable competitive position, and the ability to function regardless of what the government is doing to the money supply. He never chased the war. He never tried to predict when it would start or end. He positioned himself before the stress arrived, held through the noise, and bought more when the panic created prices that the underlying reality did not justify. That is not a strategy that sounds exciting. It never does. Until you watch what happens to everyone who chose the exciting version. The number in your account still looks the same. But what it can actually buy, what it can actually do, what it can actually become, that depends on what you are holding underneath the number. That is the question war has always forced people to answer. And the people who answered it clearly, before the noise got loud, were the ones who came out the other side with something real. Not just a number, a position. One that still meant something when the dust finally settled.